All right, Mr. Green, it's good to see your shining face again. How are you?
Good.
Good, man. You've been keeping busy. I've heard from a lot of realtors in the biz that January was a hot month.
Yeah.
You're seeing something similar?
Oh, definitely. Yeah. Our volume was way up in January. So lots of new applications coming in, and our February month already looks like it's off to like a crazy start. So, yeah.
Yeah, everything that I've been hearing, man, it's like more and more demand, less and less supply, and things are going crazy again.
Yeah, definitely. I know. I thought a number of months ago that this would be a pretty robust spring market, and I think it's ramping up for that. I think that we'll finally see in the next few months here in many markets. I think we'll finally see that bottom out period in pricing. So I think now might be a really good time to buy because it's right before that a wave of new buyers enters the market, and supply is quite low right now. But I don't think sellers have realized that it's slowly becoming perhaps a bit more of a seller's market than it has been for a long time.
Yeah, I totally agree. We've actually just made 3 or 4 or 5 offers in the last week because I see something similar, and Victoria is pretty similar to a lot of pockets in Vancouver in the sense that, and we're up and down the island, but yeah, I'm really interested in. There's 2 flips that we got just about to start. There's a third one that I'm really interested on a condo downtown where if I get it for the right price, all we have to do is basically sleep on it for a day and I'd be able to make money. But we'll see. Anyways,
Yeah.
That's fun. Even more fun is your line of work.
Mortgages.
Mortgages, yeah.
Yeah.
Uh,
Yeah.
so tell us, what's new in your world?
Um, not a lot, but a couple of little minor changes. So we're hearing a little bit that the government is admitting that the stress test had a bit more of an impact than they chose or wanted to. I think they're starting to realize that some of the changes that they've made may have gone a little too far, and they might make a small adjustment or a small little nudge back. It's interesting because a few days ago, we actually were hearing a little bit that the government was saying, hey, you know what? I think there's a bit of a problem here where the stress test rate is a bit too high. So the problem is that their intention was to be charging and surcharging the rate by about 2%. And so what they do is they take either the rate plus 2% or what's called the MQR, the mortgage qualifying rate, which currently is 5.19%. The problem is that MQR rate is based off of a kind of around a 5-year posted rate with most banks. And most banks don't move their 5-year posted rate, even though the actual rates you get move all the time. So right now, I just got another email from a lender, because bond rates have been slipping, fixed rates have been dropping. And on a owner-occupied purchase, clients can get as low as 2.79%. Unfortunately, rental properties and uninsured mortgages are a bit higher. They're a little over 3%. But the reality is if you're buying a property for yourself and it's less than 20% down and you're getting a rate of 2.79, but the lenders have to use a rate of 5.19 to qualify you, that's 2.4% higher of a rate that they're using to qualify you, not just 2%. And I don't think that the government really had that intention here. I don't think the government really understood that banks don't really move the posted rate. They're very static. And when rates move up and down, the actual rate you get, posted rates move every 4 months often, even if rates are dropping. And then right after that news came out, then TD a day or two ago said, oh, our posted rate is going from 5.9 down to 4.99. And so I have a feeling that we might see here is a bit of a push from the government telling banks, hey, you know what, drop your posted rate. And we're going to look at dropping the mortgage qualifying rate down to maybe 4.99. It won't have a huge impact on borrowers' capabilities on an individual basis, but the impact would be that borrowers would qualify for about 2% more. And so if you're buying something for 500 grand, or you're trying to qualify for 500 grand, you qualify for about 510 now. But if you start to look at over the landscape of how much people qualify for over the thousands of potential buyers, that's a lot of extra money that people are now qualifying for if they make this move. But I think that's coming very, very soon.
Yeah, so you're going to see some of the other big 5 kind of jumping on board, do you think?
Yeah, and the reality is the posted rate almost makes no difference to clients Here's one of the reasons that the banks like having a really high posted rate. When you go to discharge and break a 5-year fixed rate mortgage, for instance, what they do is they look at what's called an interest rate differential penalty, which can easily be 2 to 5 times more expensive than the 3-month interest penalty that shouldn't apply. But what they do is they take, let's say they have 3 years remaining on your mortgage. They take the 3-year posted, subtract the discount that you got off of your 5-year fixed rate term, and they determine what the rates that they're going to use to calculate your differential penalty. So you'll get a difference in interest rates over the remainder of your term to qualify. So I was to look at this, here, let me pull up TD's rates right now here. So what they would do is if you got a rate of 2.79% and the 5-year posted rate was 5.19, what they'll do then is to determine what your breakage penalty is. They're going to take a look at the current 3-year posted, subtract that 2.4% rate off of it, and then look at the difference between your rate of 2.79 and that new net rate. And I'll tell you what, it's a stupid low rate. So the 3-year, let's see here, what's the 3-year? Okay, so the 3-year posted rate right now with TD is 3.89. If they take that 2.4% discount you got initially, they're going to compare your current rate of 2.79 to a magical mystery rate of 3.89 minus 2.4. So 1.49% would be the rate they use to calculate the differential on. So that spread between those two rates over the remaining 3 years on the amount that you owe would be your penalty calculation. And guess what? It's really, really expensive.
No kidding.
And so the crazy thing is, instead of like a non-bank lenders, we call them, they'll take the actual interest rate that you got and the actual current new rate that a new customer would get for a 3-year term, and that will be your penalty calculation. Basically what the banks do is they heavily discount their 5-year rates and their 4-year rates, the ones that clients are more likely to take, and they don't offer a deep discount for a 3-year term. Like TD's current rate for a 3-year term is like 3.09, but their posted is 3.89. So they only offer a small discount of 0.8, but a 5-year fix, they're offering a really deep discount. And the reason that they do that is just to bury people in big penalties to leave them.
Right. Yeah, it totally makes sense on that business perspective. And I didn't actually know how that was calculated before. It was always just a mystery. I just figured that you put your hand into a barrel and whatever number comes out, you're like, oh yeah, here's a $15,000 bill, slap in the face.
Yeah. And that's why we advise for a lot of our investor clients to just go variable. The penalty is capped at 3 months interest. And you can always lock it into a fixed rate if you want to at a later date. But if you're getting a mortgage through a major bank, these IRD penalties are often 2 to 5 times more expensive. And they can apply, they should only apply if the rates are dropping, because what happens is the banks lend money to you and me, then they bundle up the mortgage, they sell them. So they're paying an investor now a certain rate as they bundle up the mortgages, sell them, get cash back in, and pay an investor. And the spread between what they lend the money to you at and what they're paying the investor at is their profit margin. So technically, if they lent money to you at 3%, Steve, and what they'll probably do is package up the money and then bundle it up and sell it, and they're probably paying an investor 1.5%. They need to maintain a spread just for profit margins. And if they're paying somebody else 1.5% and then rates really drop, they don't want people just refinancing and getting the lower rate without paying, because they still have to maintain that margin. Mm-hmm. So that concept makes sense. But sometimes we see rates actually go up. So the cost of funding that same mortgage is actually higher, and the banks still stick it to the client with a major penalty just because of this posted rate shenanigans.
Mm-hmm. When clients are in that position where they have to break a mortgage, and let's say it's 2 or 3 years in, so like the thick of things, is there much negotiation that can take place on that regard, or is it nope? It's like, here's the sticker price and that's it.
No, I mean, if you're leaving the bank, then they're going to kick you on the way out. So you can try to port the mortgage. So you can take that mortgage and port it and take it with you to the new property, and then you just add on the extra money you need at the new current interest rate. So that's the most common way of avoiding the penalty. Sometimes if you are paying a penalty with that lender but getting a new mortgage with them, then sometimes they'll reduce the penalty by a certain percentage. Like Scotiabank usually will refund about 20% of your penalty if you get a new mortgage with them. But for many lenders, it's just, this is their cost. And that's where in many cases, if you're getting a 5-year fixed rate and you can go to many different lenders, we'll recommend that you consider a non-bank lender because that penalty cost can be much cheaper.
Gotcha. That's good to know, actually. Just like if you're getting the same price or same rate on it, make sure you're getting the right product so that the risk down the road is actually reduced.
Yeah.
So you said like if you're going 20 down or if you're buying an income, no, if you're going 20 down on a primary residence, you said like it's 2.79.
Less than 20% down. So owner occupied, high ratio we call it. So an insured mortgage.
Okay. And then if your investment property, you're just over 3.
Yeah, in general. So like TD's rate for a rental right now is 3.19 is their standard rate, but they give me a bit of a discount because I send a lot of business there, so it's a bit lower than that. But that's kind of their standard 5-year fixed for a rental property. So there's a pretty big gap or difference. Maybe I should talk about that too, because when the lenders bundle up the mortgages and sell them, this is actually what caused the U.S. subprime crisis to happen, where bundles were getting bundled up and they were being stamped AAA and they were full of junk. So what they would do is they would actually have some good mortgages in there and they'd sprinkle in a bunch of subprime mortgages, and then they'd get an insurer like Moody's or Standard & Poor's to stamp it and say, yeah, this is a AAA bundle, and then they'd sell it. And so the demand for these bundles of mortgages kept going up and up. So international investors were like, oh, I love these bundles of mortgages. I want more of it, but I want a bit of a higher rate of return. So literally what happened is banks in the US were being told, hey, we need to push more money out. The default ratio in the US before the subprime crisis went haywire was about 4%. So 4% of their mortgages were in current default. If they were underneath that number, they were told to push more money out the door. To put that number in perspective, during the subprime crisis in Canada, the ratio of mortgages that were in default was 0.33%. It was 1/10 during the subprime crisis. In the US, leading up to it, it was 4%. So literally banks were being told, push more money out. We want more bundles of mortgages. This is a great asset. And because the asset was being called AAA, it was easy to sell. Now what happened is when this all came to light and they realized, oh my God, these weren't actually AAA, these were full of junk, international investors said, well, we don't want to buy mortgages anymore. And that was a big problem because the way that Canadian banks fund most of the mortgages is not based off of the deposits that are held in the bank. It's actually being able to bundle these up. They're called mortgage-backed securities. And so what happened is a lot of the banks ended up going to CMHC and getting mortgages insured even if the client put more than 20% down. So it's a lot easier to sell a bundle of mortgages to an international investor if you can say, hey, these mortgages are 100% backed by the Canadian government. It makes that mortgage much more profitable and easier to sell. So essentially you have multiple tiers of pricing now within the mortgage industry. The best pricing is for an insured mortgage because the mortgage is insured, which means it's the best possible asset you can have because it's fully backed. Also, the borrower pays the insurance premium that's added to their mortgage when they put less than 20% down. Then the next tier is what's called an insurable mortgage. And this is interesting because a few years ago, the government changed a few of the policies where they wanted to take a bit of a step back and stop insuring as many mortgages as they had been. So some things that they stopped doing was, if there's a purchase over $1 million, they won't insure it. If it's a refinance, they won't insure it, which is a big deal. If it's a rental property and it's 1 unit, then they won't insure it. If it's 2 to 4 units, they will. Don't know why. It's a weird one. Yeah, so there's little details like that. Oh, and amortization. If it's over 25 years, they won't insure it. Mm-hmm. So now we have this band where if the mortgage is insurable, so if it's a purchase under $1 million and the client's okay with a 25-year amortization and it meets that criteria, then you can get a better interest rate. It's not quite as good as insured, but it's pretty good. And that's where a lot of the time the lenders say, well, if you put 35% down, the cost of the insurance is cheaper than if the client puts 20% down, because the insurance cost is higher depending on the loan to value, the percentage of the value that they're borrowing. So you go insured is the best pricing, then insurable is second best. Then the next band is what's called just a conventional mortgage. So that's a regular owner-occupied property, but you want a 30-year amortization or it's purchased over $1 million or something like that. And then the last one is rental properties and stated income programs and specialty products, basically, where they're using a different way of underwriting to do a higher risk deal. And so every time you go from one band to the next, generally speaking, the pricing increases about 0.1 to 0.2%. And so you see a huge wide gap where a owner-occupied less than 20% down deal is 279, and then if you're buying a rental property, you skip 1, 2, 3 steps, and you're way over here, and a rental property is like 3.19%. It's like a 0.4% difference.
Hmm. So I think like I'm just trying to do some quick math in my head because we just made an offer. Beck and I just made an offer on a condo downtown. It was like 375. And I was bouncing back and forth between like 5 down to 20 down and seeing what that expense difference would be. And at that
Mhm.
price point, I think it was like 150 or 200 bucks. So for your average property in Victoria, let's say you're buying investment properties, at that's, let's just say double. So you're around that, 7-ish and change mark. That's $400 difference in terms of like what cash flow could be there, and just with that point forward rate.
Yeah. Yeah. It adds up. I mean, that's the interest cost itself, right? So, and we do find this. This is when building a real estate portfolio. There's a couple of different strategies, but sometimes for young professionals, one of the strategies is to buy a residence with 5% down that would be a good rental property in the future, and then you buy another residence that you upgrade, and you buy a new residence 5% down a year or two later, and then you buy another residence 5% down a year or two later again. And the reason that this works is that most people think that you have to be a first-time home buyer to buy a 5% down, but you don't have to be a first-time home buyer. You just have to be buying a personal residence or what's called a second home. So a second home is where you're going to have immediate family use the property, or you use the property for personal use or something like that. So we can't use any rental income from it, so it's harder to qualify. So the plus of this strategy is you're buying what eventually become rental properties, but you only put 5% down into them. Mm-hmm. The downside is you have to have a really high income to be able to service all this debt, because you're getting 95. In fact, by the time you add the CMHC premium of 4%, you're 99% leveraged on this real estate. And it's on a 25-year amortization, where if you buy a rental property with 20% down, you can do a 30-year amortization. And so the payments are a lot higher. And there's more scrutiny in general just dealing with a mortgage insurer, because it's the bank plus the insurer that have to agree to lend you the money. And that's where it can be harder. But for somebody that's, a new lawyer and has a bunch of student loan debt, but is now making 120 grand a year, and also has a spouse that's making 100 grand a year, those individuals don't have a lot of assets, but they have a really high income. And that's a good strategy to really kickstart their investing career off the ground.
Yeah. I mean, that's a great strategy. If you can qualify for it, that's the best thing you can do. Like, especially if you can, if you're young enough and making that type of income, house hack that from day one.
Yeah.
Hop into a place 5 down, rent out your other suites, or your, downstairs suite, or your bedrooms, or whatever you've got, garage, driveway, whatever you can, and live for free, maybe even make some money, and then as quickly as possible move into that next one and repeat. And I know I've got a lot of buddies that are doing that right now here around the Victoria area. That, yeah, it kind of sucks for 2 or 3 years or 4 years or 5 years or whatever it takes because you're living with 4 other people.
Mm-hmm.
That wealth that you generate from that 5 years of buying 2, 3, or 4 properties with such, little amount down will drastically carry you for the rest of your life.
Yeah, it definitely kickstarts everything big time, right? So it's a great strategy. And if you're buying a 2-unit place, then you're looking at the amount of rental income you get from the basement suite can definitely service quite a bit of your mortgage debt. If it's a $1,200 a month basement suite, then that's servicing the cost of borrowing like 250 grand in mortgage. Or if you buy a fourplex, I have a lot of clients that have a fourplex. They live for free. They live in one of the units for free. Now, yeah, you've got 3 different tenants, right? And sometimes people are even crazy enough to have like roommates inside of their unit if they're single and they're barely home or whatever. But it's possible to like be living for free, basically.
Mm-hmm. No, definitely. As we kind of wrap up here, I'm just curious on where you think, interest rates are going to go over the near future, if there's whispers on that, or if you've got some insider information or anything like that.
I do.
Yeah?
Oh, yeah. Big insider information, yeah. Okay, so here's an interesting point, okay? So first of all, when we're talking about bundling up mortgages, and this is how things all kind of tie together, when mortgages are bundled up and sold, this is why bond rates have a really big impact on fixed rate mortgages. So if you're watching bonds, that's where where fixed rates are heading. So if bond rates or bond yields are dropping, fixed rates will drop. There's about a 98% correlation. So interestingly, I'm looking at the bond chart, and about 2 to 3 weeks ago, bonds just went What happened about 2 or 3 weeks ago?
The virus in China.
Yeah. The coronavirus is literally dropping mortgage rates in Canada.
It's wild.
So what's happening now is because of the coronavirus, now you have a bunch of cities being shut down in China. Manufacturing is shutting down. Now they'll be importing less goods from places like Canada and the US to build those products and then export them out. That means other countries buying less of China's product. So all of a sudden, this little what seems like an isolated event, a quarantined event, is now having an impact around the world. And what happens when you have high volatility items like this happen is it pushes interest rates down because money flocks to safety. Canada is one of the safest places to park money because it's a stable government. This is just a very safe and stable place. So what happens is if you're raising money by issuing bonds for your company or for your country, and now you have a lineup of people out the door, you can lower your yields. And some people will leave your lineup, but you'll still have enough money and be able to raise enough money for what you want. And so that lineup it creates pushes yields down and it lowers the interest rates, which then mean that fixed rates, which are correlated with the bonds, will also drop. So there's definitely some downside pressure on fixed rates. Also, the Bank of Canada, there seems to be a lot of downward pressure with regards to the prime rate too. A few months ago, back in late like summer to fourth quarter of 2019, there's a point about an 80% chance that Bank of Canada dropped the prime rate by March or April. That has changed up and down and up and down. The last one that I was looking at a couple of weeks ago before coronavirus was about 50-50 chance that it dropped March or April again. Well, I think that coronavirus is coming up. I have a feeling that it's probably higher than 50%. The general outlook is that the Bank of Canada will drop interest rates by anywhere from 0.25% to 0.75% in the year 2020 in the next 18 months or so. My take is probably 1 to 2 drops, so probably 0.25% to 0.5% drop. And with regards to whether you should go in a fixed rate or a variable rate, I'm highly recommending people consider a variable rate right now because even though this is a weird position for the rates to be, but variable rates are actually priced a bit higher than fixed. But if the Bank of Canada is going to be dropping, you might end up being at a lower rate. Also, if you're in a fixed rate mortgage, you can lock it into a fixed rate. So if the variable rate doesn't change, but fixed rates keep dropping, you actually just lock it into a fixed rate at no cost to you. You just call up the lender and see what their fixed rate is at that time. So I think a variable rate's a good place to be because there's downward pressure on both the Bank of Canada to drop the prime rate and also on fixed rates right now because of the coronavirus.
Man, that's so interesting. Like I could geek out on that all freaking day. I think that yes, Canada is extremely safe to invest money. Vancouver, I love Victoria a little bit more. Maybe there's a little bit of bias there.
Yeah.
But like I tell everybody, like there's so many fundamentals here in our economy in Victoria that cushion any type of potential recession. Now, the one caveat to that is like acts of God and international what ifs that we can't predict, right? And this is one of those things that we couldn't predict 6 months ago or 2 months ago or whatever beforehand, but it is having that effect, and it's almost like a positive effect in a sense because we're gonna potentially see better rating. One last question. I don't know if I know this, but you were saying like variables now might be able to drop down. You can lock in at any point. For qualifying for either one of those, does that change at all? Like, is it easier to qualify for more if you're going variable or fixed, or vice versa?
Not really, unless the variable rate is a bit higher, which means that they might price it a bit higher. So, for instance, if a variable rate is 3.25, the Bank of Canada rule is that you either take the mortgage qualifying rate of 519 or the rate you're getting plus 2%. And that's the rate that you have to use to qualify. So if you're getting a rate of 3.25 on a variable, you add 2% to that, they would have to qualify you at a rate of 5.25 instead of 5.19. That's a really, really minor difference. So yes, there's a minor change here. Variable rates in general, though, aren't that much higher, and usually the variable rate plus 2% is still hovering right around the mortgage qualifying rate anyway. So wouldn't really change a whole lot. It was a number of years ago when the Bank of Canada changed the rule where if you qualified for a variable rate or a term less than 5 years, you had to use this qualifying rate. And when they changed the stress test a few years ago, they decided, you know what, it's just every term, including a 5-year fixed. On that note, actually, an interesting point that I've been hearing a little bit more about, the government really likes long-term rates. They would prefer to see Canadians in long-term mortgages. And one of the thoughts that's getting thrown around a little bit is that they might try to incentivize borrowers in Canada to take long-term rates by lowering the qualifying rate a bit. Because the whole point of the qualifying rate is like, hey, if you take a 5-year term and the rate is 3%, but then you renew and the rate's 5%, can you afford it if the rate jumps up? Now, if you take a 10-year term, that's a long time. It allows you to pay down a lot of that mortgage. I think there's less of an importance to stress test that mortgage if you're taking a 10-year mortgage. And so 10-year rates actually recently have dropped. TD right now is 3.6% on a 10-year rate, which is really good. It's only a 0.5% spread between the 5-year rate and the 10-year rate. And if the Bank of Canada decides to maybe stress test that by only 1% instead of 2%, that means that to qualify for a 10-year rate, you'd actually be qualifying at 4.6%. And if you took a 5-year rate, they'd be qualifying at 5.19. So some interesting thoughts, and I think they might look at that and evaluate that and maybe make a tweak, and that might be an interesting tweak for them to take.
Yeah, that will be interesting to see how it plays out, because I think the states are more so based off of longer term pieces, right?
Yeah, most of the mortgages are based on 30-year money.
Yeah. One
of the reasons for that is that the U.S. is considered the worldwide economy. And so if you look at it, if the money is primarily tied to bonds, it's a lot easier for them to attract 10-year or money into the country, because it's viewed as a country that in 30 years, it will still be stable. It doesn't have a lot of dollar risk. So there's not really a whole lot of risk of investing in a country like the U.S. for 30 years. Canada is still, the U.S.'s little brother, right? So it doesn't really have that stable economy when you compare it to the U.S. And that means it's a little harder to attract 30-year money, but it still is stable enough that it can attract 10-year money. So you see that the less stable economies are more likely to only attract short-term money into their countries, whereas a stable economy like the U.S. is one of the only countries really that attracts a lot of 30-year money.
That's interesting.
Yeah.
Well, man, have you got any speaking gigs or events coming up?
I do, yeah. So tomorrow and Saturday, I'm speaking at the World Financial Outlook Conference with the fellow Michael Campbell, who does Money Talks on the radio at CKNW. He runs this event, and I'm speaking on the Friday and Saturday, and I'll talk about financing, how it's become more difficult, and I'll talk about what a lot of our clients are doing, which is doing commercial financing. I'll be talking about becoming a private lender and becoming the bank, and also talking about, I gave you a sneak peek already, but talking about how coronavirus is impacting fixed rates in Canada. And then the following weekend, I'm speaking at another conference, and that's the Investor Summit, and that's talking about, again, I'm going to have a similar presentation about the challenges that our clients are looking at in investing and being able to qualify for mortgages. But there are a couple of programs that have come out in the last little while that make it a bit easier. So net worth programs and programs for those that are self-employed to make it a bit easier to qualify, as well as a new lender that will finance clients that have over 10 properties.
Really?
Yeah.
Oh, that's interesting. I got somebody for you.
Oh, cool. There you go. Yeah. They're a lot of work, but now we have a lender that will consider it. So
right on. I like the sounds of that. Cool. Well, if anybody's in Vancouver, go hit those up. Hopefully we see you at our meetup in the near future. We'll align that for sure.
Yeah. In March, I'll be at your meetup.
In March, that's right. Yeah.
Yeah.
Yeah, we got you booked for March. I can't remember the date on it. I think it's the 17th. But we'll let everybody know. So yeah, really appreciate your time, man. That was really enlightening. That was really cool to talk about how different things are affecting different pieces. And that's one of the things I absolutely love about this game, man. It's like the smallest little detail across the world. Not that coronavirus is small, but like something across the world can completely change things here, and the same can happen all over the place. So there's constant juggling that takes place, and it's fun to kind of try to piece all the puzzles together to beat the game.
Exactly. Yeah, it's interesting when you start to piece it together and understand how the money works behind the scenes for mortgages. Then all of a sudden you have a new new twist to it or a new input, you realize why it affects the outputs, right? Mm-hmm. So when you just say coronavirus affects mortgage rates in Canada, you're like, what the hell? That doesn't make any sense. But once you understand how the money is bundled up and lent behind the scenes and how it's tied to bonds and then how bonds are affected by things like the coronavirus, et cetera, it starts to kind of piece together. So I hope I didn't put too many people to sleep, but it's pretty cool to understand, especially for us nerds.
Yeah, no doubt. Yeah, no, I think a lot of people will appreciate it. And lots of people that we know that are following or that are watching right now really respect your judgment and your insights. So thank you so much for taking the time today again. And for anybody in Vancouver or Victoria, go hit up his events. That Investor Summit should be a really good one. Looking forward to seeing you on the island in March.
Yep. Thanks, Steve. Thanks for having me up.
Of course, man. Talk to you soon.
Yeah, you too. Bye.